COMEX vaults drain 785K daily. February 27th deadline, 785,000 troy ounces, disappearing from registered vaults every single day. Dubai physical price, $127 per ounce. COMEX paper price, $73. Someone knows something the market doesn't. February 27th isn't just another settlement date. It's a forced decision point. And the mathematics don't allow for both sides to be right. What happens when the vaults go to zero before the deadline arrives? Welcome to Daily Silver Crisis. If you value strategic intelligence over market noise, if you prefer institutional analysis over entertainment, then you're in the right place. We'd appreciate it if you'd subscribe, not for algorithms, but because these briefings track developments that won't appear in mainstream financial media until it's too late to act on them. Before we proceed with today's analysis, we're curious. Where in the world are you watching this from? And what's your primary business or professional background? Drop a comment below. We're building a community of serious decision makers, not spectators. Now, let's examine what's actually happening inside the COMEX vault system and why February 27th matters more than most realize. On January 15th, 2026, something unusual began appearing in the COMEX vault reports, the registered silver inventory. The physical metal actually available for delivery started dropping at a rate nobody had seen before. 785,000 troy ounces per day, every single day, without pause. To understand why this matters, one must first understand what registered actually means in the COMEX system. The exchange operates two categories of inventory. Registered inventory sits in approved warehouses, tagged and available for immediate delivery against futures contracts. Eligible inventory also sits in those same warehouses, but it's simply stored there. Not available for delivery unless the owner specifically converts it to registered status. Think of registered inventory as bullets loaded in a gun, and eligible inventory as bullets still in the box. Both are silver, but only one can actually be used when someone pulls the trigger. Right now, someone is pulling the trigger, fast. The COMEX vault system started 2026 with approximately 38 million troy ounces in registered status, at 785,000 ounces per day. Simple mathematics tells an uncomfortable story. The system has roughly 48 days of inventory. At current withdrawal rates, February 27th sits exactly 43 days from when this pattern began. This is not coincidence. February 27th represents the final delivery notice date for the March 2026 silver futures contract. On that date, anyone holding a long futures position must decide: take physical delivery, or roll the contract forward to a future month, or close the position entirely. Anyone holding a short position faces the opposite decision: deliver physical metal, or buy back the contract, or hope the long side accepts cash settlement instead. The problem emerges when both sides make incompatible choices. When more longs demand delivery, than shorts can actually provide. The vault reports tell us this scenario is not theoretical anymore. It's mathematical. It's happening in real time. Warehouse data shows specific patterns. JPMorgan's vault in New York, down 2.4 million ounces in 3 weeks. Delaware Depository, down 1.8 million ounces. Brink's facilities across multiple locations, showing coordinated drawdowns. These are not random retail investors requesting their 100-ounce positions. This is institutional scale movement, the kind that requires armored transport, customs documentation, vault storage arrangements at the destination, the kind that costs serious money to execute. Nobody spends that kind of money on logistics, unless they believe the metal in their possession is worth more than the paper claim to that metal. And here's where the numbers get interesting. In Dubai's physical market, actual silver bars trade at $127 per troy ounce. On the COMEX, the paper futures contract settles at $73 per troy ounce. Same metal, 74% price difference. This spread doesn't exist because of transportation costs, or refining fees, or any normal market friction. It exists because one market trades physical metal that actually changes hands, and the other market trades contracts that mostly get rolled forward, month after month, without delivery ever occurring, until suddenly, delivery does occur, and the system discovers how many paper claims exist for each actual ounce of physical metal. 5 years ago, COMEX silver contracts had roughly 40 ounces of paper claims for every ounce of registered physical inventory. Industry specialists called this normal because less than 2% of contracts typically demand delivery. But what happens when that percentage changes? When 5% demand delivery, or 10%, or 15%, the mathematics stop working. The vault data suggest we're finding out the answer to that question. Right now, in real time. With a hard deadline 43 days away, the exchanges have increased margin requirements 3 times in the past month. This is not normal. Margin increases mean the exchange sees growing risk. that one side of the trade cannot meet its obligations, so they demand more collateral, more cash posted up front, to reduce the chance of default. But margin increases also force another effect. They trigger automatic liquidations of positions that can't meet the new collateral requirements, which creates forced selling or forced buying, depending on which side of the trade gets squeezed. Right now, the registered inventory keeps draining, 785,000 ounces per day. And February 27th keeps getting closer. Someone, somewhere, is doing the same mathematics and reaching the same conclusion. The question isn't whether this matters. The question is, what happens? When the calendar reaches February 27th and the vaults contain less metal than the delivery notices demand, that answer comes next. 7 Feb on. December 1st, 2025, something happened in Beijing that most Western analysts missed entirely. China's Ministry of Commerce issued a quiet announcement: export restrictions on antimony, gallium, germanium, and refined silver, effective immediately. No press conference, no dramatic statements, just a technical regulatory update buried in bureaucratic language. But the implications were anything but technical. China controls approximately 70% of the world's refined silver production. Not mining, refining. The difference matters. Silver gets mined in Mexico, Peru, Australia, and dozens of other countries, but most of that raw ore gets shipped to Chinese refineries, where it's processed into the 999 fine silver bars that industry actually uses. Solar panel manufacturers need it, electronics producers need it, medical equipment makers need it, defense contractors need it, and suddenly, the primary source of refined supply just announced restrictions. The announcement didn't ban exports completely. It required special licenses, additional documentation, government approval for each shipment. In practice, this creates uncertainty, delays, questions about whether approvals will come, or how long they'll take, or under what conditions they'll be granted. Businesses hate uncertainty. Procurement managers hate it even more. So they do what businesses always do when supply becomes uncertain. They stockpile, they secure physical inventory, they stop trusting paper promises, and start demanding actual metal. This is where the COMEX vault drainage connects to geopolitics. Look at the timeline. December 1st, China announces export restrictions. December 15th, COMEX registered inventory begins declining faster than historical averages. January 15th, the drainage rate accelerates to 785,000 ounces per day. February 27th, delivery deadline for March contracts. The sequence is not random, it's strategic. Someone looked at China's announcement, did the mathematics on available Western supply, and decided paper claims weren't sufficient anymore. They wanted physical metal, in their possession, under their control, now. Meanwhile, in Dubai's physical silver market, something equally revealing was happening. The premium over COMEX prices kept climbing. In normal markets, arbitrage keeps prices aligned. If silver trades at $73 in New York and $127 in Dubai, traders should buy in New York, ship to Dubai, and pocket the $54 difference. This arbitrage should close the gap within days, but it's not happening. Why? Because the $73 COMEX price is a paper price. It represents a contract, a promise to deliver silver, not actual silver in hand. The 120 set on a Dubai price is a physical price. It represents metal you can touch, store, use in manufacturing, or hold as an asset. The market is telling us something critical. Paper promises trade at a 43% discount to physical reality. This spread exists in other markets too. The Shanghai Gold Exchange shows similar premiums for physical delivery. London's physical silver market shows tightness. Refineries report Yana delivery times stretching from weeks to months. This is not a COMEX-specific problem. This is a global physical shortage, being temporarily masked by paper market pricing. But masks eventually come off, especially when deadlines arrive. Let's examine what China's restriction actually does to the supply chain. Western silver demand runs approximately 550 million ounces annually. Industrial use, 520 million ounces. Investment demand, 30 million ounces. Western mine production, 180 million ounces. Western refining capacity, 220 million ounces. The mathematics show a 330 million ounce deficit. That historically got filled by Chinese refined imports. China's export restriction doesn't eliminate those exports, but it does create friction, uncertainty, and most importantly, leverage. When a business needs 10,000 ounces for a production run next month, they can't wait for a Chinese export license that might take 6 weeks. They need metal now, so they go to the spot market. They go to COMEX. They demand delivery, and suddenly, the registered vaults start draining 785,000 ounces per day. Here's where the arbitrage signal becomes critical for understanding what's really happening. Sophisticated institutional buyers see the same data everyone else sees. They see China's restrictions. They see the supply deficit. They see delivery delays at refineries. They see the physical premiums in Dubai, Shanghai, and London. And they make a calculation. If I hold a COMEX paper contract at $73, but physical metal trades at $127, what's my actual exposure? If COMEX can't deliver physical metal, they'll offer cash settlement at the paper price, $73 per ounce. But replacing that metal in the physical market costs $127. That's a $54 per ounce loss on every ounce they needed. So the smart money does the obvious thing. They demand delivery now, while registered inventory still exists, while the exchange can still fulfill contracts, before February 27th arrives, and the mathematics stop working entirely. This creates a feedback loop, more delivery demands. Drain registered inventory faster, which increases physical premiums, which motivates more delivery demands, which drains inventory even faster. The technical term for this is a run, like a bank run, but on a commodity exchange, everyone rushing to get their metal before the vault runs empty. The COMEX has seen delivery squeezes before, but never with this geopolitical backdrop, never with China controlling 70% of refined supply, never with physical premiums this extreme, never with industrial users competing with investors for the same limited registered inventory. The question isn't whether this creates stress. The vault data already confirms the stress is real. The question is what happens when an unstoppable force meets an immovable deadline, when delivery demands exceed available supply, and February 27th arrives anyway. That collision is coming, and somebody is going to lose. The only question is who. 7. Feb in March 2022, the London Metal Exchange did something it had never done in its 145-year history. It canceled trades. Nickel had squeezed from $29,000 per ton to $101,365 per ton in less than 24 hours. A Chinese company called Tsingshan Holding Group had massive short positions. When the price exploded, they faced margin calls exceeding $10 billion. They couldn't pay. The exchange faced a choice: force Tsingshan into bankruptcy, trigger defaults across the entire nickel market, and potentially destabilize the broader metals complex, or cancel the trades. Pretend the squeeze never happened. Reset the price and give the shorts time to cover. They chose the second option. Buyers who had purchased nickel at $80,000 or $90,000 per ton suddenly found their trades erased, their profits eliminated, their contracts voided. The exchange justified it as protecting market integrity, but what it really protected was the short side, the institutions, the connected players. This is the precedent that hangs over COMEX right now, because the same mathematics that broke nickel are developing in silver, and the same institutions that got rescued in nickel hold significant short positions in silver futures. Let's examine who actually sits on the short side of these contracts. COMEX doesn't publish trader identities, but regulatory filings tell part of the story. The Office of the Comptroller of Currency tracks bank derivative exposure. As of Q4 2025, 4 U.S. banks held 87% of all precious metals derivatives exposure in the banking system. JPMorgan Chase, $42 billion notional exposure. Citigroup, $18 billion notional exposure. Goldman Sachs, $14 billion notional exposure. HSBC, North America, $9 billion notional exposure. These aren't small proprietary trading desks. These are systematically important financial institutions, the kind regulators call too big to fail. Now here's what makes this interesting. JPMorgan operates the single largest COMEX silver vault. They hold registered inventory, and they hold massive derivative positions on both sides of the market. This creates what regulators call a conflict of interest, what traders call an information advantage, and what everyone else should call a problem. When you control the vault, you see the withdrawal patterns before anyone else. You know who's demanding delivery, you know how much registered inventory actually remains, you know when the mathematics stop working, and you can position accordingly. The vault data shows JP Morgan's own warehouse losing 2.4 million ounces in 3 weeks. Are they withdrawing their own metal? Are clients withdrawing? Are they converting registered to eligible to make it unavailable for delivery? The reports don't specify, but the pattern is clear. The largest vault operator with the largest derivative exposure is seeing dramatic drawdowns right before a major delivery deadline. This is not coincidence. This is chess. Institutional chess, where the average investor doesn't even see the board. Let's talk about what happens on the long side. Who's demanding all this physical delivery? The CFTC publishes a weekly commitment of traders report. It breaks down positions by category. Commercial hedgers. These are miners, industrial users, manufacturers who use silver in production. Large speculators, hedge funds, commodity trading advisors, institutional investors, small speculators, retail traders, individual investors. As of February 1st, 2026, commercial hedgers showed net long positions of 78,000 contracts. That's 390 million ounces of silver. At current registered inventory levels, that's more than 10 times what actually sits in COMEX vaults. Now, not all of those will demand delivery. Historically, only 2 to 3% actually take physical metal. But what if China's export restrictions change that calculation? What if industrial users decided they can't trust future supply? What if 10% demand delivery instead of 2%? That's 39 million ounces. The registered vaults currently hold about 30 million ounces, and dropping by 785,000 daily. The mathematics are already broken. Here's the trap that's closing. Short position holders face 3 options. Option 1, deliver physical metal. But where do they get it? They can't pull from registered vaults that are already draining. They can't import from China without uncertain export licenses. They can't buy in the physical market at $127 to deliver against contracts they sold at $73. That's a $54 per ounce loss on potentially millions of ounces. Option 2, buy back their short contracts. But this creates a squeeze. When shorts try to cover, they must buy futures contracts from longs who know the shorts are trapped. Price discovery stops being about supply and demand. It becomes about pain threshold. How much loss can the short side absorb before they capitulate? The nickel squeeze showed this dynamic clearly. Price went vertical because shorts had no exit. Option 3, hope for cash settlement. COMEX rules allow the exchange to mandate cash settlement. If physical delivery becomes impractical, the shorts pay the paper price. The longs accept cash instead of metal. Everyone goes home. Except the longs who actually needed physical metal for industrial use still don't have metal, and the price discovery mechanism is now completely broken. If a manufacturer needed 50,000 ounces for solar panel production, and COMEX gives them cash at $73 per ounce, but physical metal costs $127 per ounce to actually acquire, that manufacturer just took a $2.7 million loss. They're not going to accept that quietly. This is where the London Metal Exchange precedent becomes critical. When the exchange changed the rules to protect the shorts, they destroyed confidence in the entire contract. Nickel trading volume on LME dropped 60% after the cancellation. Participants learned the lesson. The rules only apply until they don't. Until someone important enough is losing. Then the exchange steps in and rewrites reality. If COMEX follows the same playbook, if they mandate cash settlement to protect the short side, what happens to confidence in all COMEX contracts? Not just silver, gold, copper, crude oil, natural gas. Every commodity contract is just a promise that delivery will occur, if demanded. But if that promise gets broken in silver, why should anyone trust it in gold, or copper, or any other commodity? Here's what the institutional players are calculating right now. The shorts are looking at their exposure, their margin requirements, their funding costs, and the calendar. February 27th is not negotiable. It arrives whether they're ready or not. The longs are looking at physical premiums, Chinese export restrictions, refinery delays, and vault drainage rates, and they're making a simpler calculation. Get the metal now, while it's still available. Both sides can't be right. The registered inventory doesn't support both positions. The mathematics don't allow it. Something has to break. Either the price breaks higher, or the contracts break entirely. Either the shorts capitulate and cover at massive losses, or the exchange intervenes and changes the rules. Either physical delivery occurs as contracted, or the COMEX joins the LME in the graveyard of trusted institutions. What nobody's discussing publicly, but everyone's calculating privately, is the counterparty risk, not just will I get my silver, but will the institution on the other side of my trade survive this? Because if a major bank holds $42 billion in precious metals derivatives, and a significant portion goes wrong simultaneously, that's not a trading loss, that's a solvency question. And we've seen how those questions get answered. 2008 taught us the lesson. When systematically important institutions face failure, the rules change. The government intervenes, the losses get socialized. The question isn't whether this matters. The vault data proves it matters. The question is who pays. When the mathematics finally force a resolution, that answer is 26 days away. September 15th, 2008. Lehman Brothers collapsed, not because they ran out of ideas, or because their business model failed, or because markets turned against them. They collapsed because counterparties stopped trusting them. Credit lines disappeared overnight. Trades that should have settled didn't. The firm had $639 billion in assets on paper, but when nobody would trade with them anymore, those assets became irrelevant. Liquidity is confidence, and confidence is binary. It exists or it doesn't. There's no middle ground. This is the real risk developing in the COMEX silver situation. Not the price of silver, not the profits or losses on individual trades, but the confidence in the settlement system itself. Because silver isn't just a precious metal for investors. It's an industrial commodity that keeps factories running. Let's walk through what happens if physical silver becomes unavailable to manufacturers. A single solar panel contains approximately 20 grams of silver. Global solar panel production runs at 800 million panels annually. That's 16,000 metric tons of silver, or roughly 514 million troy ounces, just for solar. Add electronics manufacturing, 240 million ounces annually. Medical equipment and devices, 55 million ounces. Automotive sensors and electrical systems, 61 million ounces. Defense and aerospace applications, 18 million ounces. The industrial economy runs on silver, not as decoration, as critical infrastructure. When procurement managers at these companies look at the COMEX situation, they don't see a trading opportunity. They see a supply chain crisis. If they can't secure physical metal, production lines stop, contract deliveries get missed, revenue disappears. This is why the Dubai premium matters. $127 versus $73 isn't just a price spread, it's a signal that physical availability has decoupled from paper pricing, and for businesses that need actual metal, the paper price is irrelevant. They'll pay whatever the physical market demands, because not having the metal costs more than overpaying for it. Here's the cascade that executives are trying to prevent. Stage 1. Procurement managers see COMEX registered inventory draining. They increase physical orders from traditional suppliers, refineries, dealers, direct mine purchases. Stage 2. Everyone else's procurement managers see the same data. They all increase orders simultaneously. Suppliers face order backlogs they can't fill. Delivery times extend from weeks to months. Stage 3. Panic buying begins. Companies offer premiums for immediate delivery. Physical prices spike further above paper prices. The arbitrage gap widens instead of closing. Stage 4. Some manufacturers can't secure supply. They reduce production or substitute inferior materials or delay product launches. Revenue guidance gets cut. Stock prices react. Stage 5. Investors notice industrial disruption. They question other commodity supply chains: copper, lithium, cobalt, rare earths. If silver can dislocate this badly, what else is mispriced? What other paper markets trade at fantasy prices? Disconnected from physical reality? This is systemic risk, not contained to one commodity, not limited to one exchange, but propagating through industrial supply chains, financial markets, and business confidence. The Federal Reserve watches these dynamics carefully. They learned from 2008. Liquidity crises spread faster than anyone expects. One institution's problem becomes everyone's problem, when counterparty trust evaporates. So what tools does the Fed have if COMEX faces a delivery crisis? They can't print silver. They can't issue Federal Reserve notes and create physical metal. The commodity either exists or it doesn't. But they can provide dollar liquidity, emergency lending facilities, swap lines with foreign central banks, guarantees for settlement obligations. The playbook from 2008 still exists. The question is whether it applies to commodity delivery failures or just financial institution solvency. That distinction matters. In 2008, the Fed backstopped banks. But if the problem is physical commodity availability, no amount of dollar liquidity creates more refined silver. This is where China's position becomes strategically significant. They control 70% of global refining capacity, they've implemented export restrictions, and they're watching Western commodity exchanges face delivery stress. From Beijing's perspective, this is leverage. Not military leverage, not financial leverage, but commodity leverage, the kind that matters when economies need physical inputs to function. If Western manufacturers face silver shortages, Chinese refiners can offer supply, on China's terms, in yuan instead of dollars, through bilateral agreements instead of open markets, with political conditions attached. This is economic statecraft, quiet, technical, buried in commodity market mechanics, but potentially more effective than any sanctions or tariffs. Because you can't run a modern economy without industrial commodities. And if the existing pricing and delivery infrastructure breaks down, alternative systems emerge. Systems that might not denominate in dollars, might not clear through Western exchanges, might not operate under Western regulatory oversight. The COMEX situation is a test case. Can Western commodity exchanges maintain delivery credibility when physical supply tightens? Can paper pricing mechanisms survive when they diverge this far from physical reality? Can the dollar-based commodity trading system handle the stress of actual scarcity? February 27th provides the answer. Here's what business leaders should monitor. First, registered inventory levels. If they continue dropping at 785,000 ounces daily, they hit zero around March 10th. before the March contract delivery period ends, that's a mathematical impossibility requiring exchange intervention. Second, physical market premiums. If Dubai, Shanghai, and London premiums keep widening, it signals physical scarcity is accelerating, not resolving. Third, margin requirement changes. Additional increases signal the exchange sees growing default risk. They're demanding more collateral because they don't trust current buffers. Fourth, delivery notice patterns. COMEX publishes daily delivery intentions. If notices exceed available registered inventory, the system breaks visibly in real time. Fifth, exchange rule changes. Any modifications to delivery procedures, cash settlement provisions, or force majeure declarations signal the exchange is preparing to change rules to manage failure. For businesses with silver exposure, the strategic question is simple. Do you trust paper contracts to deliver physical metal when needed? If yes, maintain positions as normal. If no, secure physical inventory now, pay the premium, accept the carrying costs. Because the cost of not having metal when production lines need it exceeds any premium paid today. For investors watching this develop, the question is different but related. What does it mean when a major commodity exchange can't reliably deliver the underlying commodity? What does that say about price discovery, market integrity, regulatory oversight? The answer matters beyond silver. It matters for every commodity contract, every derivative, every paper claim on physical assets. The financial system operates on trust. Trust that contracts will be honored, trust that exchanges will facilitate delivery, trust that prices reflect reality. When that trust breaks, everything reprices. Not just the commodity in question, but the entire framework of paper claims versus physical assets. We're 26 days from finding out whether that trust is justified, whether COMEX can deliver against the contracts it issued, whether the mathematics work, or whether the rules change to make uncomfortable facts disappear. The vault data says the mathematics don't work. 785,000 ounces draining daily. February 27th approaching. Registered inventory declining toward zero. Something has to give. Either supply increases dramatically, or demand decreases dramatically, or the exchange intervenes, or the contracts default. Those are the only options. And 3 of them represent system failure. The question for business leaders, investors, and anyone who depends on commodity markets functioning properly is not whether to pay attention. The data demands attention. The question is what to do with that attention. How to position, how to hedge, how to prepare for a scenario where paper and physical diverge so far that one of them stops being relevant. History suggests it won't be physical that loses relevance. When the vaults go empty, the paper becomes worthless, not eventually, immediately. February 27th is the test. The countdown is running, and the mathematics don't care about anyone's opinion. They simply are. True or false, working or broken, 26 days to resolution, one way or another.